Welcome back, everyone, to Getting In, a College Coach Conversation. I'm excited to welcome my colleague, Wally Boudet, who's a former financial aid officer at both Loyola University New Orleans and University of New Orleans, to the show. We're talking about preparing to spend your college savings. Hi, Wally.
Hi, Beth. Hi, glad to be here. This is
Thrilled.
such a topical time, such topical item because the calls are just coming in wanting to know what to do.
Absolutely. So you think you save for college and then when it's time, the first bill comes, now you're just immediately dipping into your savings, but there's actually a little bit of strategy that you need to employ. But why don't
Absolutely.
let me back up and let's start with 529 accounts. And I'm curious to get your thoughts. It's something we talk about from time to time on the show, but what makes these such a popular investment tool for college planning and spending?
Sure. Great question. It, it all comes down to taxes and penalties, really. This is the only account that allows people to invest post tax, let the account grow, withdraw the money for qualified education expenses, and not pay any penalties or taxes on the growth and or the withdrawal. So it's just the perfect tool in order to use everything optimally in order to save and in order to spend without incurring additional taxes and penalties.
Right.
Um, Coincidentally, I had a call this morning. It was a call with an eighth grade parent, in fact, and she is planning on using her IRA. And I'm like, okay, well, let's talk about this for a second. And she's like, well, I've got these accounts set up. I'm confident with the growth on this because I'm managing it. And I'm like, okay, but here's the deal. And this is unknown to many people, is that families can withdraw from IRAs prior to their retirement age if the expenses that are spent on are education related. And that could be even for spouses, children, grandchildren, wide array of family members. Okay. So the key there is that you're going to avoid or be able to avoid the 10% early withdrawal penalty. However, the entire distribution is going to be taxed. And depending on where you are, what tax bracket that you're in, and depending on how much that you're going to need to withdraw, if you were counting on it paying for an entire year at an in-state public, you could be talking about withdrawing 30,000 bucks a year. If you're talking about a private, you could be talking about $80,000 of withdrawals a year. So realize the taxable implications on that are not going to be available or not going to be present with the 529. It makes it the most beautiful thing.
Right.
Next, next, and I'm sorry to jump in, next is that many states, 30, over 30 in fact, have state tax deductions or credits. Okay, 30. So that's a great opportunity to save on your state taxes. Average across the nation is about 120 bucks a year, which is not a bad thing. And then you've got this outlier in Indiana where the savings are approximately $360 a year in tax credits. So by a combination of those two things, it makes this 529 a special animal that's going to help out in the long run.
Right. The only thing I would say is if you're an older parent and you're going to hit retirement age before your child is going to college or right around the time they are, it is possible that you could use your IRA to pay without the tax penalty, but I don't think that describes most parents. So I just throw it out there for those parents who might be a little bit older and thinking that that's a strategy they were going to employ.
If I'm not mistaken, that's 59 and a half. And so that could be applicable again. So yeah.
Yeah. But I think point that you're making is a really good one, which is that those 529 savings vehicles are really attractive for the reasons that you shared. Here's the big question, and this is where when you get ready to start spending that money, these are questions hopefully you already know the answers to, but maybe you haven't really looked all that closely at it. And so you mentioned specifically qualified education expenses, right? And so those are going to qualify for that tax-free withdrawal. What are those expenses?
Well, interesting because in every paying for college call that I do, I make sure that families understand an average of what the school's cost of attendance is. And the cost of attendance is an actual term that's used. You could go to look at any school and do a web search for University of Alabama, out-of-state cost of attendance, and that's going to be comprised of tuition and fees, room and board, books and supplies, transportation, and miscellaneous or other. So, of those, the qualified education expenses are everything with the exception of transportation. And so, we're talking about tuition and fees, books and materials. We're talking about computer equipment. We're talking about internet access, where it's not provided automatically included in the rent or the dorm fee or anything like that. Special needs equipment for handicapped or other students. They can also use those. So it's a broad array of information, a broad array of qualified education expenses. Again, just make sure that you're not getting close to that line where you're questioning some of the things that are excluded. And I mentioned transportation. So that's kind of a gray area. We don't know
Yeah.
what that is. Obviously, if you're going across country, your transportation expenses may be higher. So that's one thing that can be excluded. Also, in many schools, costs of attendance, they include student health insurance. And
Mm.
student health insurance, where it is incurred, where you're using the school's policy for that, is not going to be considered a qualified education expense.
Got it.
So make sure that you're looking at that.
Where can you go for an official list of those? Is there a place where that exists?
There are several websites that are highly reputable that you can feel comfortable going to. And really a simple web search of qualified education expenses for 529 or flip it around 529 qualified education expenses. There are a couple of sites that deal specifically with that and really helpful, really easy to read dialogue. There are some that are more formal, such as the IRS website or some of the investing houses websites that make it a little more complicated. But yeah, just do a web search and that'll display everything that you need to do. I think an
Awesome.
important part going in there, though, is that, and this is kind of associated with it, but not necessarily, is going to be the reporting or the record keeping that needs to go along with it. Because in many cases, you may be applying those funds to a third party, meaning if your son or daughter is paying rent and your son or daughter is paying rent directly to the landlord and you are reimbursing your son and daughter, you're going to probably want to make sure that you are keeping track of the actual expenses incurred and the actual withdrawals from the 529 so that if you're ever audited, you've got a verifiable paper trail in order to figure out what the money was spent on. For money that's sent directly to the college, it's easy.
Sure.
You could go and look dollar for dollar as to tuition and fees equals this. This was my withdrawal for this. Room and board was this, and this was my withdrawal for that. So yeah,
Okay.
just be mindful of that.
Here's my next question. Does it always make sense that you start paying for college with your 529 funds? Should you be immediately going to that to pay, or are there other approaches that you might recommend?
That's a really timely question and one of the most asked questions right now, especially considering the downturn in the market.
Right.
Many families' 529 funds are bleeding right now and they're suffering. And I think that there's a valid question of should I leave the money in with hopes of a rebound, with hopes of a market rebound in order to negate some of the losses that I've experienced? And I think point number one is that I haven't seen anyone give a crystal ball look and say that, oh, yeah, in 2 years, the market's going to turn around and you're going to be made whole.
Right.
That's point number one. So, secondarily, there's really a few things that you want to consider. Number one, if you are eligible for need-based financial aid, and so you are completing the FAFSA or the CSS profile, you're including the value of that 529 as a parental asset. Okay. So that parental asset is negatively affecting your eligibility for need-based aid because they're assessing a portion of that towards the expected family contribution or student aid index as it's going to be known soon. So know that leaving those money in the accounts is going to affect your eligibility for next year. Okay.
Right.
So again, if you're on the cusp, you may want to liquidate those accounts. Now, assets are assessed for the need analysis formulas at a much lower basis than income.
Right.
So you'd have to have a fairly significant withdrawal or change in order to affect your eligibility. So that might not be a tremendous issue, but just know that if you leave it in there, it is going to be counted against you for next year.
Okay.
Secondarily, many families are eligible for the American Tax Opportunity Credit or AOTC. Okay. If you spend $4,000 on eligible expenses, meaning tuition and textbooks, you could take a $2,500 tax deduction. Okay. There
Mm-hmm.
again, there's eligibility based on income, and it's very strict eligibility. Many families don't qualify for it just because of that. However, if you do, that $2,500 in benefit is probably going to give you more value than the deduction that you're going to take on your 529. Since you can't double dip, meaning you can't use both benefits the same year, make sure that you are taking advantage of the AOTC first by using that $4,000 from your personal funds in order to pay for tuition and books in order to get that $2,500. And then using your 529 funds to balance the rest of the charges that are out there. Okay.
Got it.
So
Mm-hmm.
that's a way that you can use both of these different things and take advantage of everything. Again, the main thing is whether or not the family is going to qualify for that American Opportunity Tax Credit, which has those relatively low income requirements. So, you know, kind of a way to do it. The next,
Do you have a ballpark figure on those income? Because,
unfortunately, with the notes that I've got, no,
okay.
right off the top of my head,
Okay. No
I'm not
worries.
positive there.
I'm pretty sure we have some blogs on this. So for our listeners, if you're interested, well, you could probably do a web search and it will tell you what the income cutoffs are. But also, you could look on our blog, and I know this is something we've blogged about in the past. But sorry, didn't mean to interrupt you. There was another point I think you were about to
Yeah.
make.
One point, and this is really the point that affects the most people. And this goes into the families who are concerned with their losses in the funds right now because of the market. Well, if the option to using your 529 is going to be a loan, say, okay,
Hmm.
the federal plus loan rate for 22-23 has been increased to 7.543%. When you compare when you compare the cost of that interest versus your funds, well, in any case, you need to use the one that's going to give you the best financial impact. So in here, even though your earnings are terrible, you're still going to be better off than borrowing the money at such a high rate. Now, there may be an opportunity for a private loan where, based on the parent's credit, you're going to have a great opportunity to get a slightly lower rate than the plus loan, but still, in those cases, it's my thought and experts' thoughts that until the increase on those funds come about to where you're earning more than what the rates available on the loans are, it's best to use your funds rather than the loans that are available.
Got it. Last question for you as we come close to the end of our time. What if you've saved this money in a 529 plan and now your student has decided that maybe they're not going to college,
Yep.
or maybe they are only going to go, you've saved for 4 years and they're going to do a 2 year program,
Right.
or they got so much money, scholarship money, that a college is, this is a rarity, that college is essentially going to be free for them.
Yep.
What do you do now?
Uh, there's still a lot of great options in order to use these funds so that you're not incurring the penalty and the wrath of the IRS if you don't use the fund. Number one is that you can spend up to $10,000 a year on eligible family member student loan payments
Okay.
per family member. Okay, so that can be the beneficiary, it could be the sibling, uh, your other son or daughter, it could be your spouse. $10,000 per year on eligible student loan payments in order to help exhaust those. You've got the opportunity to transfer them to another beneficiary, and the list of possible beneficiaries is expansive: son, daughter, grandchild, grandson, niece, nephew, in-laws, foster children, everyone. Great opportunity there. Last, include it as part of your estate and change the beneficiary to your grandchild.
Yeah.
You've got the opportunity to do that. Now, again, there's no reason for you to necessarily liquidate these accounts, even though your child is in nowhere thinking about a grandchild.
Right.
There's
Right.
no reason for you to liquidate these funds early on. You've got the opportunity to hang on to them and make sure they're being spent so that you're not incurring the penalties that you would have if they had been used for non-qualified education expenses. So that phrase again comes into play.
Sure. Well, I appreciate it. Really helpful information. Thanks so much for joining today.
I'm glad to help. Glad to be here. Thanks so much.
Wonderful. All right, we are going to take a quick break. And when we come back, we're going to be talking about all of the updates to the Common App for this year. So don't go away.